All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market off to a fairly sluggish start. S&P up about 4 points right here. We are seeing bonds trade just a little bit higher. Dollar lower, tech lower in general. A lot of the bigger winners over the last week kind of pulling back just a little bit here today, or at least so far this morning. Now, we had the jobs report here this morning, and I have this zoomed in to the minute chart on S&P futures, and the jobs report, we saw S&P futures fall on the report, but they fell from right up here, about 29.84, down to 29.77, right? Pretty small reaction compared to other jobs reports, right? And one where we saw ADP jobs number yesterday and beat expectations, and today's number, it missed, right? So natural reaction is an initial sell, normally is. And we get that sell. And then, we see the market climb on back and create a reaction high to go with its reaction low down here. Now, this reaction high and low, this is about a 10-point range, okay, which for a jobs report is fairly small, okay, fairly small. And, this reaction range, it used to be where you could look at these reaction ranges, you mark them, and then you let them play out, right? And if the lower reaction range gets broken, you go and you short. If the upper reaction range gets broken, you go and you buy. But over the last, I would say about year and a half, we've seen a tendency shift when we've had these, even when we've had them with the Fed, when we've had them with, jobs reports or, other types of news. And very often, it just seems like the case is we get this breakdown or break up of the reaction range, and all the stops get hunted, and then there's a quick, fast whipsaw pushing it right back into the range. And we saw that happen here on the open this morning, and we saw this kind of sell, then boom, pop right on back. We're not talking about massive volatility or massive ranges here, but just this kind of reaction range, element, how it's played out over time, and, what we're kind of seeing play out here so far this morning. And I don't think we can look at the jobs report and say anything different about anything here today. I don't think it's going to change investors' minds about a whole lot. And we are seeing, just some things tick around here with it. Now, it is putting a little bit of pressure on bonds, and so we are seeing, putting a little pressure on bond yields. So we're seeing bonds, move up just a little bit, and that's hoping to kind of push stocks like AT&T a little bit higher as this thing just continues to be an absolute monster here. We've talked about AT&T a lot this year, and whatnot there with the dividend yield and all the bad news priced into it, and the HBO debacle and the DirecTV debacle. But AT&T just continues to climb, and it isn't a 6% dividend yield anymore, but 5.68% dividend yield, which is still incredibly high. Now, I'm going to come back to AT&T, but before I do, for the challenge, there are no new signals here on the board this morning. MGM has a crossover. We could see this trigger here today. And then I'm holding Apple. Apple down about 60 cents here this morning. Not a lot in it. Nothing really to speak of. The stop date comes in on Monday for Apple with the adjustment that we made on the fresh new signal. Apple does have its, Apple Days or whatever they call it here on Tuesday. And I don't want to be holding the position for that, but we're not going to see a lot of implied volatility loss or anything like that, with the Apple stuff coming out here on Tuesday, and they'll be talking about their products and all those types of things. So, I'll as long as we don't break, as long as we don't break down here with Apple, we'll hold that here into the weekend and look to pull it off on Monday. Hopefully with a nice secondary surge. Yesterday's surge put in a nice little increased delta for us. But, we need that secondary surge for it to really kind of pay us off in a nice way here. Other than that, the options just, floating here between down, I think it was down 30% at one point, up 30% at one point, and just fluxing between that 30% range there on the option. So really the option just hasn't been able to, really go anywhere despite, some movement here in the overall stock. Okay. All right. So back to AT&T, and I want to bring up a chart here. And I was asked about this, and AT&T, is it time to get off? It time to leave AT&T? From an investment side. And, I want to go speak to that here just a little bit. And the short answer is no, it is not time to leave AT&T from an investment side. In fact, it's still a good time to get in. And I don't base that off of charts, right? I don't base that off of a weekly or a monthly or anything else. But here you can see the monthly and what it looks like. AT&T has been in a 3-year consolidation, and it is breaking out of that consolidation. But if we come in and we chart here for AT&T, we chart the dividend yield, right? And, this was the big premise for my argument of being a buyer of AT&T, for using this stock as, hey, you know what? You want to hold something through this year, through everything that's going on, AT&T is going to pay. And, the whole premise here behind this was the dividend yield, and the dividend yield being up here just sky high, up here in the 6 to 7% range, which, the last time we saw that for AT&T was back here in 2010, and it wasn't all sunshine and roses for the market back here. And AT&T rose from 25 all the way up to 37. Had about a 50% run over the course of 2 years after its dividend yield exceeded that 7% mark. And, the dividend yield has pulled on back. It is now 5.6%. So it is pulled on back as the stock has rallied nicely here. But we're not at one of those periods where we're in a dividend low, right? And the rallies on AT&T, what we have seen is that the dividend tends to push back below about 5%, to about upper 4% area, and that's what I would be looking at. It's not something where I'd be looking at the chart on AT&T and going, hey, you know what, I want to do this or that because of this and that. The whole premise and argument to get in was based on dividend yield. The whole premise and argument to get out will be based on dividend yield here for AT&T. And I do think there is a chance that we see AT&T dividend fall all the way down and maybe even break 4%. If they are able to show some better operating numbers, show that some of the merger stuff is, gone a little smoother, if there's some positive that starts to come out of AT&T, we could see it really kind of push down below 4% on that yield. What would it have to, why would the yield push down here? Well, because the stock price pushes on up, and I think you're still looking at a stock with a good chance of pushing back above 40, and to go from about 28 up to above 40. That's about a 40% gain on the stock. That's a pretty monster gain for a big blue chip like AT&T. Now Verizon, it doesn't always trade the same. If we come and we look at Verizon, its dividend yield is near the lows. It's down here at about 4%. This is not one that I look at and go, wow, I want to be a buyer of Verizon because of dividend yield. In fact, it's still one where the rotation that we have seen, right? We have seen a rotation into AT&T. AT&T has been an outperformer here of late, and I do expect that it will continue continue to outperform Verizon, barring some sort of massive shift in, the market or some sort of news element there. Okay. All right. So that's AT&T. Gold. Yesterday we saw gold pull back and, pull back, fairly sharply. I was asked about it a couple times. And look, for me, for gold, I'm not willing to get in until it has a substantial pullback. And it's not there, right? Yesterday, what we saw in gold had nothing to do with fundamentals changing, had nothing to do with, the actual element of the gold trade changing, had everything to do with some of the fear element coming out. And, this fear element in gold is an element that, left for quite a while. And, if we look back here in October, November, and December, when the U.S. equities went haywire, right? When the market was significantly more volatile than what we have seen in July and August, right? The market, the S&P, all over the place, bigger drops, bigger pops. Gold really didn't do a whole lot, right? This wasn't a fear trade at that time. It just didn't have those elements in it. And we had seen that for a while, that gold was no longer a fear trade. It wasn't one of those, hey, market's going crazy, let's go buy gold. But we saw some of that come in this summer into gold, where we wake up, market futures are down, gold's up. We saw it trading on a fear element here and losing a little bit of that U.S. dollar correlation. Now, the fundamentals for gold, I think, are still very bullish. But yesterday's action is just some of that fear element coming out. And some of these bigger moves that we've seen in gold have been the fear elements coming in or out, here with it. The ultimate trend is not fear-based, right? It's not a, oh, well, you know what, the market's going to go to hell in a handbasket, that's why investors are buying gold. That's not what we're seeing here. But some of the little waves we see, based on kind of that fear element, and I do think that's what we're seeing in gold. We see some of that fear element coming out here yesterday. And, for me, I'd like to see gold trade back down into the 130s, to be able to be a buyer. Anything below 140, I'll start to be interested in looking. But, it's not there for me yet. And that includes some of the miners. I'm just not interested in something like GOLD yet. One-day drop, sure. You know what? We can see one-day drops, and then it just resumes to a big pop. It's not what I'm expecting to see. Ultimately, we could see it, but that's not what I'm expecting and not what I'm going to play for here. Now, the last one I want to show is oil. Now, oil here back to about 55 here today, and oil has been, for lack of a better word, stuck at this level all year. It has managed a brief blip higher, and it has, pushed, a little bit lower than this level. But this has been a really kind of big mid-level here for oil. When you look at the market, the economic fears are balanced with, some of the Iranian situation. Some of the supply increases here in the U.S. are being offset by some of the OPEC restrictions or supposed supply decreases. You have a really balanced story when it comes to oil. And that just isn't changing, right? That there's nothing that's showing that balanced story is going away or that an imbalance is going to be created. Yeah, if the U.S. lifted sanctions on Iran, sure, we'd be talking about an imbalance created, and we'd probably see oil tank. If we see, some strong economic growth around the world, we're going to be talking about a demand imbalance and demand rising. So, that's going to push oil up in that type of situation. But, so far we've seen all year, we've seen the bullish stories counterbalanced with the bearish stories in a very balanced manner for oil. And, we don't always see that. And we are seeing that right now. And, just something I don't expect to change in a big way, here just yet. Ultimately, when we look at the supply increases that are out there, around the world, and, we look at kind of where the demand side is and the sluggishness of the economic growth, it is something where I would not be surprised to see another leg down in oil, see it trade back into the 40s. But that's not something I'm interested in playing aggressively. Right here and right now. Oil does have some seasonality associated here to it. If we come in and we just put on. Let's see here. So, yeah, seasonality, WTIC. We just come in and come back here about 10 years, right? You can see September, pretty average, flat month. October tends to be a down month for oil, and then you can see November and December. What's interesting is if you look at these, the average gain in October, November, December is actually a loss, right? We tend to see oil losses during these months, and even though half the time the months are higher, but we tend to see losses in those. And so we are coming into a seasonally weak time. If we go back 7 years, you can see the biggest losses for oil have been in October, November, and December, and the biggest gains have been in February, March, April. All right, so we are coming into a seasonally weak period for oil, so I just would not be surprised, given just some of the macro elements there and everything else that we're seeing. I would not be surprised to see oil, oil tank for lack of a better term there, which it would hurt the oil sector, but would be a net positive for the overall global economy. It would put more pressure on Iran. It would put more pressure on Russia, and those countries are already under some pressure. And we saw Russia yesterday, talk and basically say, look, we're going into an arms race again. Here we go. And, we'll see how the U.S. responds to that. But, we have Iran. I mentioned in my comment this morning what's going on there. But those could all affect the price of oil. But when we look at the macro, the seasonality, path of least resistance for oil is probably lower here. Okay. All right. Now, the last thing I want to go take a look at here with you is the challenge. And I get, probably 2 to 3 times a week, I get a question on, different various changes to the challenge. Well, could we change this? Should we change that? Everything wants to change, right? And I'm very resistant to a lot of tweak and a lot of change to it. Why? Because it's taken over 3 years to develop this, and I've explored most avenues, just small tweaks here, so even some big tweaks. I've explored a lot of that. I have data to suggest one thing or another, but it doesn't mean that when something comes in, I don't go and take a look at it. But 100% of the time here so far, this challenge, those types of suggestions, they either don't pan out from a metric standpoint, or they take away some of the freedom that the challenge has in it, meaning, we're dealing with more times during the day, more decision-making, times and all of that, which is something I'm very highly resistant to. Excuse me. But I've mentioned there's going to be a tweak or two going into the next challenge, and this is something that we've looked at for a while, and how do we handle it? How do we deal with it? And that is the implied volatility. When we come into the trade data, right? Now we're running with gains here for the challenge. Some good gains, even though the market's been incredibly choppy. But when we look at the losses, right, and we look at the various losses, and even we look at the winners, and we start to calculate out the implied volatility loss. The implied volatility loss in this challenge is very high. It is very high. In fact, it's if my rough, and I haven't done pinpoint, log it when the trade is entered, when the trade is exited. But if my rough estimation is right, we've suffered almost $6,000 in implied volatility loss on our options. Now, some people say, well, that's huge. Other people say, well, that's just the cost of trading options. And, I look at it for the most part, that's the cost of trading options. But I look at what the implied, volatility loss, could be, and could we do something different to alter that? Because if we change the option, right, we lose some of our gains, right? We start to, this $1,000 gain right here or $1,300 gain on GLD, if we make some tweaks to it to try to get better implied volatility, this is only a $500 gain. And so it's one where, we could cut out some of the implied volatility loss, but unfortunately, that's going to cut out a lot of the gains, for the most part. So, how do we incorporate it? How do we kind of go through and say, you know what, let's kind of pump the brakes on this trade or that trade because of implied volatility. This last Microsoft trade, the implied volatility was a stinger. We saw implied volatility sting us here with Microsoft before. In fact, it seems like Microsoft, we've managed to get in on the high side of implied volatility and get out on the low side of implied volatility and, not have the stock go our way during that time period. So this is the tweak and this is the change that we are looking at making, and I haven't finalized it 100%, but the data suggests, here that it's pretty good. It is a purely back-tested method here. This is not something that we front-tested here yet. So I'm always hesitant to, something that hasn't been tested in real time to implement it because back-testing, it's back-testing. It's back-testing is easy. Anybody can come up with a back-testing strategy and then, magically it doesn't work in real time. It happens all the time out there. But, this is one that I do think is going to add value without taking away value. And so we're going to put a caveat here in the challenge to where if we get a trigger, right? So let's just say MGM triggers today. And it's not, here so far. But let's just say MGM triggers today. And we go out, we look at the options, and the implied volatility on the options is significantly higher than what its recent range has been, and we're looking to buy calls, right? If the stock goes up, we're looking to take a loss there on the implied volatility side. Yeah, the delta ultimately will overcome it, and I don't want this to get in the way of the delta, right? It's one of those things where volatility is so much less than the delta that, okay, how much do you really want to deal with it? But putting in a caveat that, on days, let's go back to Microsoft, like on Microsoft's entry, okay, where we can get the signal, yet not enter the trade. At the same time, we'll put the trade data together. The stop levels. We'll put the gain levels. We'll put all the numbers in that apply to the algorithm. But essentially, wait a session or two, or even up to 3 sessions to get in. Now that's going to allow for a couple things. That's going to allow to either get in when, the implied volatility cools off the next day, which, after some signals like Microsoft, we often see happen. It'll give a chance for that to happen. It'll also give a chance to buy into a little bit of pullback. So in the case of Microsoft, 3 sessions later, we're able to get in down here, and, we have a little bit of a difference. Now, we're not going to adjust the stop levels, right? But we are going to adjust the time stops to be based on when the trade was entered. And that's what we're looking at. So giving a chance to play around the signals just a little bit, depending on the implied volatility. And if the implied volatility is just too much, and I haven't defined the parameter for it, I'm still waiting for some more data on it. But, it's something where if the implied volatility is going to affect the trade, and what I'm kind of looking at is that 20% mark. If it's going to affect it by more than 20%, then we could go ahead, we set up the signal, we set up the stop levels, and then we don't get in right there, but, have 3 sessions to decide, hey, you know what, do we want to get in? By sessions, I'm talking about morning video, afternoon video being, 2 sessions. So morning sessions 1, afternoon is 2nd, the next morning is the 3rd. And so, that would allow a little bit more of a play around. I think it would allow us to capitalize a little bit better on some of the things that have happened during this style of market right now, and something that isn't going to detract from a more trending style market, because if we're talking about a little more trending style market, the implied volatility element isn't nearly as impactful, and so it's one where the implied volatility, it's only affected by 10%. Okay, fine, it doesn't matter. We're not gonna alter anything or change anything in regards to the entry. So that is the tweak that I'm looking to make, and we've done a lot of work with it, and still have a little bit of work to go with it, but I do think I'll be able to implement it at the start of this next challenge later on here this month. Okay, so hopefully that gives a little insight into that. We will see a few watch list changes as well. There's some stocks here on the watch list that, are essentially thrown out already. I'm not trading Raytheon. I'm not going to trade Triple D. Can't trade Alcoa. Arconic, no. Just is not really tradable with how the options have changed here over the last few months. And we'll add a few stocks here to the list that I'm looking forward to being a part of and trading here with you. Okay. Alrighty. I will not be on video here this afternoon. That said, any trade signals will show up on the spreadsheet. Any trades that are made will go out via alerts and will also show up on the message feed. And we'll have the spreadsheet updated for you by the end of today here as well. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you later. Take care.